Dominic Tavella is CEO of Diversified Financial Consultants. Leo Tillman is president of LM Tillman & Company. Rod Kurtz, senior editor of Inc. magazine. And in San Francisco, we have Victoria Barrett of Forbes magazine. And also in Irvine, California, we call her the housing doctor, Dani Babb. She is author of Accidental Landlord. I have never thrown her a question that she hasn't been able to answer like an encyclopedia. This woman's mind is a steel trap. So we've got it all covered for you here, from SEC regulations to housing. And we have Michael from Detroit on the phone. Michael, what's your question?
Thank you for taking my call. I've been enjoying your show quite a bit lately.
Thank you, Michael.
I've got one main question I'd like to say. You know, when this bill came down and everybody was having a real difficult time understanding exactly what was in it, it was rushed through, and with the fear that, oh my gosh, if this thing is not accepted by the Friday, the weekend, the sky's going to fall. So now it went through, it passed, everybody expected things to turn better.
And look what happened.
And look what happened. 300, 400 points down yesterday, 500 points today. Now I hear a speech that Bush came on and said, well, it's going to take some time. Well, first they said hurry up or the sky's going to fall. Now they're saying it's going to take some time. I sure wish they'd pick one end of the spectrum.
All right, well, I'm going to try to put your statement into a question, unless I mess it up, Michael, and you can jump in if I do. But Harvey Pitt, what about that? Do you think that perhaps the market is telling us something about the bailout bill, that maybe they're not satisfied with it?
Well, I think there are a lot of problems, but that's certainly one clear conclusion. The only value that this bill had was to provide a calming effect on the markets and to give us some time to come up with real solutions. The bailout bill itself is not a solution to the problems afflicting our economy. Unfortunately, it didn't get passed promptly. It got dithered around and so on. And what we now have is a complex morass of legislation that is very difficult for people to understand and even harder for people to conceive of as solving our problems.
And Victoria, you know, if you ask business people what's the most important part of doing business in a free market, they'll say clarity. We need clarity. Even if you have more regulation, even if you have more taxes, as long as it's clear cut, that's better than having no clarity at all, Victoria.
Exactly. One of the things we've been saying for a long time is the markets hate uncertainty. And the kind of yo-yo activity we've been seeing in Washington is a hell of a lot of uncertainty. That's very unfortunate. You know, the rules are getting changed. One day you can short sell, the next day you can't. FDIC insurance is going back and increasing. I mean, the investors don't know what the rules are going to be. They don't know who Ben Bernanke and Hank Paulson are going to tap on the shoulder, presumably over the weekend, because that seems to be the time they like to let banks fail. So it's a tough time for investors, and I think that Washington created a lot of a sense that they could really solve this, and it was very political because the problems are much deeper.
Well, it's so problematic that it's the first time I've ever heard a four-letter word come out of the mouth of Victoria Barrett. Don't ever use hell again on this set, Victoria, but we thank you for that.
Times are tough, David.
Times are tough. Boy, she's getting feisty.
I looked at my 401k today.
You know, I haven't even approached my 401k. I don't want to touch it until this thing is over.
Don't.
Craig from Denver, Colorado is on the phone. Craig, what's your question?
Well, I would like to know what happened to the good old U.S. where there was nothing too small to succeed, and there wasn't anything too big to fail. Now we got only too big to fail.
Leo, is that a problem? Having put it out there that there is no bank too big, you know, we can't allow a big bank to fail. Have we really invested too much in that concept right now?
I don't think so. I believe that we are underestimating the complexity of the problem by focusing on these kinds of issues, because we have a vicious circle of the housing, financial institutions, financial markets, and the real economy, and they're exacerbating each other. So the bill is trying to fix one of the issues, but bailouts and things like that are trying to patch another problem so that it doesn't spill out into the real economy.
And Rod, you know, frankly, I have been getting emails saying, okay, we heard that Bear Stearns was too big to fail. That's why we intervened then. But why not Lehman? And then we heard we didn't intervene in Lehman, but when it touched on Goldman, a firm that Hank Paulson used to work for, then we intervened. So some people are seeing conspiracy here.
I don't know if it's a conspiracy. I mean, I think it illustrates how interconnected things are right now, and that's really a big problem. You know, I deal with Main Street for a living. We cover entrepreneurs at Inc., and we've been talking to a lot of them lately. And the problem is this uncertainty that Victoria and others have touched upon is that people are essentially scared to lend to one another. A lot of entrepreneurs are saying, well, my customers aren't spending, so I'm not going to hire because I don't know what's going to happen in 3 months. And we're just so connected at this point. You know, I would point out as far as what the markets have been doing, not a good picture, obviously, but you have to wonder, had the bailout not passed at all, would we be down even further?
I know, but you got to say, right now, I think there is no institution that is too big to fail. Heck, they were even going to cut the AAA rating of the United States government. So if they can cut that, I think anything is fair game. Guys, we're going to be right back with more of your calls and emails on this very special edition of Scoreboard. Your questions, your money, 877-249-9626 for callers. And, of course, emailers who don't want to call in, feedback at foxbusiness.com. But we'll be nice if you call as well.
In light of these developments, the Federal Reserve will need to consider whether the current stance of policy remains appropriate.
Back now with this special edition of Scoreboard. We're taking your phone calls, 877-249-9626, and emails at feedback@foxbusiness.com. What do you think of the bailout? What do you think of the market? Do you have a personal question you'd like to ask us? Ralph from St. Augustine, Florida is on the phone right now. Ralph, thanks for calling in. What's your question?
Well, you know, it's hard to understand this. We're supposed to trust these politicians and all these experts on TV on an unnecessary bailout to save us all, and yet these people can't even put this petty greed behind it without adding pork to this thing.
Yeah. Well, of course, some of the pork was, they say these were tax changes that would have been passed anyway. But Harvey Pitt, when you look at the people inside the Beltway, some of whom are directly responsible for not monitoring Fannie Mae and Freddie Mac as clearly they should have been monitored. They were not responsible for doing a lot of the stuff that they should have been doing. People, Americans, look at them and say, we don't trust you. We don't trust this bailout package to do what it says it's going to do. Should they be blamed for not trusting Washington?
Unfortunately, no. I think there's a lot of rationale behind people's mistrust, and that's why it was thought that getting a bailout bill passed quickly and that was very simple, which was the initial proposal, a 2- or 3-page piece of legislation, was the way to go. But they've abandoned that. We now have what we have, and I agree that anything in the way of this kind of legislation would be better than not having acted at all.
All right. Denny from Arkansas asked the following. He emailed us. My 401k is in Fidelity funds. Now, I've lost over $100,000 this year alone, and I'm about to retire in 2009. What do I do? Boy, Dominic Tavella, that is a tough one.
It's a tough one because there's no easy answer, okay? So the first thing you got to look at is how exactly, and Fidelity is a good management company, but how within the Fidelity funds are you allocated? What percentage of your portfolio is in stocks? What percentage of your portfolio is in bonds? Then get to know what it is that those funds actually own. What stocks, what bonds do those funds actually own? And how comfortable are you with that level of risk? And then you have to fine-tune this
Dom,
thing.
if you're 1 year from retirement, you shouldn't be any risk at all. Right?
I would agree that this, and we've talked about this many times before, you should have been downgrading the risk in this portfolio all along. You don't wake up one morning and go,
presumably,
oh, God.
unless this guy's a billionaire, if he lost $100,000, he had a lot of it in risky stocks.
I would think he did.
Not what we would call risky, but under these circumstances,
more growth-oriented.
So.
And that's not unusual. You look at last year's performance, and international was the best performing category. And next thing you know, you see people with 60, 70% of their portfolio in international. You need to have a broad base. The good news is, how long is this guy's life expectancy, right? I mean, realistically, knock on wood, he should live 20, 30 years down the road.
You don't have to pull it all out at once.
Right, don't make these dramatic changes.
Okay.
Start fine-tuning it.
Joe from Dayton, Ohio is on the phone. Hi, Joe. What's your question?
My question is, did Fannie and Freddie have the impact as the catalyst to affect the markets worldwide, the downward trend
That's
in a worldwide market?
That's a very good question, Harvey Pitt. We know that Fannie and Freddie had issued bonds and that there were a lot of foreign governments that were holding these bonds. Did they put pressure on Washington to act?
Yes, I'm sure they did, and part of the reason for the action was to give people the comfort level that their assumptions that the government would stand behind Fannie and Freddie was a real promise and not something that was illusory. Treasury as much as said so when it went forward with their plan.
All right, Harvey, thank you very much. Next on the line is Dennis from Albuquerque, New Mexico. Hi, Dennis. What's your question?
I'd like for you to maybe poll your panel there and see if my wife and I are on the right track on picking up Ford and GM stock now. And just wondering if they feel that those two companies would disappear from the United States.
Okay, let me go first to Dominic, who I already saw shaking his head no.
Listen, clearly from taking a bet, you're wagering a small amount of money and maybe someday it'll pay off. We can't manage money that way. This is a risk-reward equation, and the risk is way too great to even attempt it.
Leo, even though GM is coming out with a Volt, maybe they'll get the market for electric cars. Is there no way you'd go in now?
Very difficult to say. Obviously, we will do everything possible to sustain these companies and facilitate their development. But in general, I mean, they are under severe competitive pressures, just like financial institutions are.
Rod Kurtz, I know you represent the small and mid-sized companies, but what about the biggies? GM
Well, they were once small, too. I mean, it's certainly risky. I wouldn't bet the farm on it. I think because you look at American automakers, they have two strikes against them. One is just the economic situation now. People aren't buying cars, even fuel-efficient, great cars. They can't get the financing for it. And secondly, oil prices, yeah, they've come down a little bit, but we're talking about a future with high oil prices. GM is a little more interesting, as you point out, because of the electric car. We could see where that goes. But again, this is a big risk. You really are essentially gambling here.
Let's try to get one more caller in. Billy from Arkansas. Billy, what's your question?
I have a question about derivatives. Last week on the morning program, Alexis suggested that perhaps the derivative market would be the next shoe to fall. And she was going to explain that. And then the Wachovia news broke.
She never got back to it.
Never got back to it, and I'm confused.
All right. Well, Leo, the derivative market is very tough. I'm not sure I understand everything about the derivative market. I've tried, Lord knows, but I don't. Is that the next shoe to drop in terms of a credit problem, a credit crunch?
I don't think so. And again, derivatives can be a very positive instrument to manage risk and diversify your exposures. So derivatives are used in different ways by different financial institutions. And the problem with the current environment, both in terms of derivatives and CDOs and all of these complex instruments, that current financial disclosures do not allow you to see the risks that financial institutions have taken through derivatives.
So the derivatives might actually be more risky than we know.
They could be, but in general, derivatives are used by financial institutions to hedge their bets and diversify their risks. So I truly doubt that the next big problem will come through derivatives.
Okay, I want to thank Harvey Pitt, by the way. He has to run. He leaves us now, but we are going to be right back with a lot more of your calls. We got a lot of people on the line and emails on this special edition of Scoreboard. Your questions, your money. We're going to get another gauge from Americans, what you are saying on talk radio. We're going to go to a talk radio station in San Diego next, right here. We are back now with a special edition of America's Nightly Scoreboard. We got lots of emails coming in. And before we show you some more and take some more of your calls, we want to check in with our friends over at San Diego radio station KOGO. Host Roger Hedgecock is live on the air right now. His listeners are listening to all of us and hearing us, and they want to chime in on what we've been talking about. Hi, Roger.
David, how are you?
I'm great, thanks. You want to go to the callers?
We absolutely do. We've got some terrific callers, and I want to just start with this. You know how we were told a couple of days ago? Listen, there's a credit crisis. Nobody's going to be able to get credit. It's completely gummed. You know, in my local community, that just hasn't been true. I've got a GM now of the local Ford dealer. You want to just take a second to hear his story?
Sure.
Here's Bill Drew. Yeah, Bill, you're on. Go ahead. Hello, Bill. I'm not getting Bill.
Yes, I'm here.
All right, Bill, now tell me, is there a credit crisis at Drew Ford in San Diego?
Absolutely not. Ford Credit, as is the case with most all the captive lenders, they are here to finance cars, and in good times or bad, they're here. It's not based on a FICO score. It is a factor, but it's not the determining factor. And Ford Credit or GMAC or Toyota or whoever it is, they don't make a living unless they finance vehicle sales.
Well, and there you go. Money to do it.
Absolutely.
There you go. And Bill, thanks very much for that call. So there you go, David. We're wondering, where is the credit crisis?
Well, a lot of it clearly, Roger, was scare tactics on the part of people who were trying to sell this bailout bill last week. And again, the question is whether they went so far that nobody's going to believe them when they come with a crisis that is even worse.
Well, there you go. Crying wolf is not exactly a long-term strategy, is it, David?
No, it's not at all. Why don't we take some more of your callers?
All right, here's Manny in San Diego. Manny, go ahead. You're on.
I'm mad as hell.
What?
Look, both candidates share in this. Well, Obama, he's a worm tongue. I don't expect anything better from him. But McCain, I am incensed with him because this bill, Roger, was not good enough for John McCain when it was just that $700+ billion bailout. Then it goes back. The Senate is involved in it, and they add another $100 billion. All of a sudden, it's okay with him. It's like he became enamored with the process, and he betrayed his core convictions.
Manny, thanks. Now, see, David, there's the thing. The crusader against earmarks voted for $112 billion worth.
Exactly. You know, you can only ignore the popular will for so long before there is a fight back. The problem is who represents their interests. I think in a political vacuum like this, Roger, and I'm sure you'd agree, eventually something or somebody will fill that vacuum. It might not be a politician of national stature. It may be a local guy. I mentioned last night Howard Jarvis in 1978, predating the Reagan Revolution. Is that these small community protests against what is happening in Washington may actually be more successful long run than somebody taking the national baton, at least right now.
David, exactly right. You're finding across this country people waking up to the fact that their grandchildren are going into debt to ensure the payments on bonds bought by the Bank of China. This is a situation that's got Americans' blood boiling.
Roger, let's take another one of your callers. We love them.
All right, let's take Steve in Chula Vista next. Steve, you're on. Go ahead.
Hello, this is Steve from Chula Vista.
Go ahead.
I have a question for you.
Yeah.
When were the banks deregulated that led to this crisis? Was it under Clinton or was it under Bush?
Well, it was under Carter first, the Community Reinvestment Act requiring all these investments. Then it was under Clinton with regard to loosening up Fannie Mae, Freddie Mac at the behest of the folks who wanted a lot more ownership in minority communities. It wasn't so much deregulating the banks, it was forcing their lending standards to be loosened up for more home ownership.
Although,
David,
Roger, if I could just throw one thing in, the split between commercial banks and financial institutions, the end of that barrier, that regulatory wall, ended during the Clinton administration. That was called Glass-Steagall. It was the Clinton administration that finally signed the bill that ended that division between those two types of financial institutions. Of course, Robert Rubin was Treasury Secretary. A lot of people raised their eyebrows because at the same time his application was in at Citigroup, he was doing what Citigroup wanted by getting rid of that particular wall. Nevertheless, both Republicans and Democrats wanted an end to Glass-Steagall. So the actual wall came down during the Clinton administration, although both Republicans and Democrats were in favor of it.
Just like Republicans and Democrats have been in favor of this bailout. Where do we the people go?
Exactly. And that's the question.
You want another call?
Absolutely.
Yeah, you want another call? All right, Jeff in Santee, you're on with David Asman at the Fox Business Channel and here at Kogo. Go ahead.
And I have been freezing in my
Jeff,
office.
Hello?
Jeff, are you there?
Yeah, I'm here, Roger.
Go ahead, Jeff.
For the last 2 weeks, I've been wondering why nobody has ever said anything about credit unions. I used to know. I grew up with the guy who used to be about 5 or 6 years ago the president of CUNA Mortgage, and I talked with him last week, and he said that CUNA Mortgage is actually doing pretty well.
Well, that's an interesting thing, David. These credit unions don't seem to have a problem. They have credit. They have people that get it. Yeah. People are paying back. There doesn't seem to be a problem.
You know, we had the head of the credit union organization. His name is Dan Mica. His brother John Mike is a member of Congress, a Republican. Dan is a former Democratic member of Congress. He claims that credit unions are in very good shape. Of course, a lot of them have the same kind of FDIC protection. I believe most, if not all of them. You might want to double check. But generally speaking, the credit unions are being run. You know, whenever you have the depositors as a real player in the institution, very much watching over the institution, you have a more safe environment to invest in. It's almost like the lower you go down in government, the more control you have, because you want to be in control of your neighborhood. That's why the folks in Washington are so out of touch.
Well, amen to that. In other words, the credit unions based in the neighborhood aren't having a problem and don't need Congress.
Right, exactly. Look, we got time for a couple more calls. Go ahead.
Oh, let's get into them here. Here's John in San Diego. Now, let's take another aspect of this, David. John, go ahead.
Hello.
Go ahead, John. You're on.
Yeah, as a teacher, I'm recognizing one thing. We don't really have personal finance classes in schools. We don't have anything really that gets in depth about, you know, how money works in the schools. And it's quite disturbing when the problem is, you know, people are in debt. Why are they in debt? Well, they're in debt because they don't understand how money really works. And so my question is, who out there is brave enough, I mean, other than myself, to actually start having a revolution in terms of getting to the kids? Because these guys are going to be the ones who are going to be making these global decisions about money.
And paying for the decisions we're making today. Now, David, there's an interesting point. Nowhere in the K-12 public school system that this teacher is aware of are we actually teaching kids, well, how this system works.
Exactly. And as a result, we see a lot of people saying that, you know, we had these loans pressed on us. We hear about predatory lending. Frankly, a lot of those protests, I think, are pushed too far. And in terms of abrogating the idea of personal responsibility, we need people to take responsibility for the contracts that they sign. But a lot of people don't have the knowledge to sign some of the loans that they've been put in. And that is part of the problem.
Let's take Steve in San Diego with a good point. Steve, go ahead. You're on.
Hello, Roger.
Steve, go ahead.
Hi. I just wanted to point out that, like you pointed out on your show, that nothing has changed as far as the laws go on what they're doing with these loans. And what Biden tipped off his hand in the vice presidential debates is they plan on adjusting the principal on these non-performing loans, which, of course, is going to be downward, and the taxpayers are going to be left to pay for that as well.
So, David, there we go. In other words, if there's going to be a real push to renegotiate these loans to a point where people can afford them, that's all well and good for them, but who picks up that tab?
We do. It's very simple. We do. We're picking up so much. You know, it's great to see these cases where the little guy's supposed to win against something like Countrywide. We saw California winning a case against Countrywide, right, where a lot of people are going to be bailed out. But I had Jerry Brown on last night, the former governor of California. He's now the attorney general. He was crowing about winning the decision. But I said, aren't a lot of people that don't deserve to be bailed out going to be bailed out? And he had to admit, yes. And the question then is, well, who pays for it? And eventually, it's all of us.
That's right. And particularly in California and in many other parts of this country, they weren't requiring a Social Security number, only a tax identification number, which someone illegally in this country can get. So they were requiring only this tax identification number. A lot of illegals were getting these loans.
Oh, man.
When the housing, the bubble burst, they took a walk, and now we're left holding that bag.
Roger, we have time for one more quick question, if you could. We love these calls.
Let's get Mark and Carlsbad into the mix. Mark, you're on. Go ahead.
Yeah. Hey, Roger, thanks for having me. The left, I just can't believe it. I was watching CNN today, and they're talking about the D word, depression. And we're at 5% unemployment. The Dow was up like 400% since 1987. We're down 30% from our all-time high. But they're like scaremongers. They're even showing pictures and video of like bread lines from the 1930s. I mean, I honestly think that Democrats want the economy to crash so they can come in and take over a wholesale government takeover.
So what would you ask Barack Obama tonight if you were in that crowd in Nashville, Mark?
I would love to look into his eyes and say, Mr. Obama, Senator Obama, what can you do to guarantee that our country is not going to become a socialist state like Europe is, and you're not going to take over the entire economy in the effort to save us?
Mark, there you go. I appreciate the call. David, there you go. A lot of people out here worried about the next president of the United States.
Well, when you see the socialization of debt, which is what we are seeing, and you have people like David Boies, a lifelong Democrat, come into Scoreboard and say, we have abandoned the free market in the United States, you have to wonder how we're going to get back to it. If indeed we are abandoning the free market in the credit system, we better work very hard over the next couple of months and couple of years to get back to it. Otherwise, we're on a slippery slope, and I don't want to even think about where it might end.
Well, neither do I, because I'm looking at this, all these bailout bills, and I'm not seeing anybody attacking the reason why we got into this. Has there been any reinstatement of sane and sensible lending standards? Has there been any rejection of these regulations requiring Fannie Mae and Freddie Mac to give these loans?
In fairness, I have to say a little bit, but I would credit the marketplace rather than politicians, because the marketplace is working in the credit system as long as politicians let it work. To the extent that they're letting it work, there are lending standards that are getting a lot more rigid than they have been over the past 5 years. But again, that's the market, not the politicians. If the politicians would let the market work, I think we'd all be a lot better off. Quick last word, Roger. Go ahead.
Well, and Barney Frank today came out and said, if you're critical of those regulations trying to get minorities into home ownership, then you're a racist. Now, that tells me that we're going to see a lot more of that kind of lending rather than a lot less.
Well, that kind of language certainly doesn't help. Roger Hedgecock, great to see you, Roger. Wonderful callers, as always. Thank you so much for sharing those callers with us.
Appreciate it, David. Thank you.
Appreciate it. We are going to be right back with more of your calls and emails on this special edition of Scoreboard. Your questions, your money, more coming up. And we are back now with a special edition of Scoreboard. We want to go back to the phone lines. We have on the phone Chuck from Orlando, Florida. Chuck, what's your question?
Yeah, my question is, why isn't anybody talking about term limits? Almost all our political and financial problems go back to longevity in political office.
Boy, I couldn't agree with you more. I absolutely agree with that. Leo, the thing about term limits is that it goes against the grain of politicians who become to feel entitled. Once they are in power for more than 2 or 3 terms, they feel, I own the place. Plus, they are able to avail themselves of all the privileges of office to stay in office. Do you think term limits is any kind of answer?
Let me use the financial analogy. The answer to this question is dynamism. Dynamism of financial institutions, dynamism of economies, and that's what we're trying to preserve. Needless to say, staying in the office for 50 years does not encourage dynamism.
That's right. And Dominic, we know that the oldest companies are the ones that are least innovative, that have the least amount of energy. It's the same with people.
Yeah, I mean, I'm totally for term limits, period.
And particularly when you hear about sweetheart deals, and Chuck, I'm sure you heard about some of the sweetheart deals that Countrywide was making with some of the people who actually drew up the bill that benefited Countrywide in one of probably the most despicable elements of this whole thing. Victoria, we talked about that. Chris Dodd got a sweetheart deal from Countrywide, then went on, after he got the sweetheart deal, to write legislation that would benefit Countrywide. That shouldn't be.
It seems like a conflict of interest, no? The real issue is money, right? I mean, if you want to be a career politician, you need money so that you can win elections. And that's where politics gets compromised, and that's where lobbyists have undue influence over politics and over Washington.
Chuck, bottom line, we all agree with you. Term limits is something we should have in the U.S. Congress. Bob from Youngsville, North Carolina. Bob, go ahead.
How are you tonight?
Fine,
Thank you very much for taking my call.
Of course.
I've been retired since 2001, and Fidelity is my holding company for all my bonds. I'm in individual bonds. And I am very, very worried with the credit crunch. If are these companies that I hold a lot of Ford, I hold Citizens Com, I hold AT&T. Are these companies going to default on their bonds since the credit is so tight that they're not going to be having any income coming in?
It's actually a great question. There is a possibility, Leo, of default. And when you have default, the bonds would not be honored.
Yes, and in the meantime, you probably will experience some volatility of your income because the value of these bonds goes down in this credit crisis. So, but probably now is the worst time at all to sell them.
Yeah, Bob, are you able to hold on to these bonds? Do you have some other income?
No, none of them have defaulted. They've been paying every single month. I am just so worried because I have, you know, I'm so invested in bonds, and I live off of a lot of the income. Sure. I do have $170,000 in the Fidelity money market, in their New York Muni money market, and I don't know if I should move that money out into a safer place.
All right,
even
well, hold on. You got a lot of questions. Let me just ask Dom, should he move that money out to a safer place, or is it okay where it is?
It's just an opinion, but in my opinion, I think he's fine leaving it alone in the money market. And if he wants to move it out, the million-dollar question is, where do you go? There's so many assets out there right now that are distressed that you almost, it might be riskier actually moving it than leaving it where it is.
Danny, do you have an in on this question? Go ahead.
Yeah, you know, it's interesting. A very good friend of mine works for Countrywide, and he said that they are very quietly offering a 5% savings account interest rate over there. And so I have mixed feelings about it. I would tend to agree to hold until it's, the market comes back a little bit. We have some less volatility, but there are some other options that we know have guaranteed rates. So.
By the way, whenever you see a 5% interest rate, you got to be careful, folks, because how are they able to offer 5%? It's because they are in something that is pretty risky. So you really want to avoid.
Look who's offering it.
Exactly. Who's offering it and how much interest they are offering. If it's a lot of interest, right now you may want to be careful. Let's take an email. Carl from California asking, I have about $6,000 in cash to invest in the market. Boy, that's good news. And I am looking into the financials. Wow. What would you suggest for the short term? Dom, I'm going to go to you first. That's a gutsy investor.
Two things. First is, if you have that much money, you really can't go out and buy a lot of individual securities. You can't get a lot of diversification. So if you insist on going into this sector, then at least do it through a mutual fund where you can own a broad-based portfolio of financial companies.
So there are mutual funds that just focus on financials.
That's right.
You agree with that? Who's nodding their head? I think Rod,
that's
go ahead.
Me. Yeah, no, I mean, that's the best news I've heard all day. The money's not in the market yet. So it's, you know, it's sort of a good problem to have. I think the concern with the financials specifically, you look at a company like Bank of America, which everyone thought was sort of the good news, or at least the silver lining of everything that's been going on, and even they haven't fared quite as well as people expected. So I think you do perhaps want to stay on the sidelines a little bit, let this shake out. I mean, this has been a crazy couple of weeks.
But Leo, what about putting a little bit, maybe not all of the $6,000, but maybe $1,000 in the financials? Is now a time to do it?
Well, I think distressed investing in general is a good idea. Now, we don't know when this market is going to turn the corner, but needless to say, prices in general across the board are distressed. So some kind of dollar cost averaging is actually what both individual investors and financial institutions are starting to consider. Dollar cost averaging, you put a little bit in at a time, right? I mean, that's the long and short of it. By the way, Citi is down to $15 a share. It was up to $22 a share a couple of days ago, but that's when everybody thought that they were going to get a piece of Wachovia. They may get a piece of it, but it's not as big a piece as they wanted. Well, we're going to be right back with more of your calls and emails on this special edition of Scoreboard. Your questions, your money, 877-249-9626. That's one possible solution. Back now with a special edition of Scoreboard. Let's get back to the phones. And we have Glenna with us from Perryville, Missouri. Hi, Glenna. What's your question?
Hi, thank you. My husband and I are very conservative, non-risk taker investments. And as part of our portfolio, besides the Roth IRAs, we also have been purchasing the maximum of $5,000 per individual to purchase the I-Series U.S. savings bonds.
Right.
Is that still a good investment? Should we still continue to do that?
Good question. Dominic, what do you think?
Absolutely. As many of you know, the I bonds are tied directly into how inflation is going to do. And although we've seen oil prices come down and commodity prices come down, with all this fiscal stimulus coming in from the government, you got to believe that inflation is going to be higher down the road. I think it's a good investment.
Victoria, do you agree?
Yeah, I'd agree, and it sounds like you're really diversified and managing your portfolio actively, which pays off. You know, it's very tempting on a day like this or week stretch like this to make drastic adjustments, and that's not smart. You have to manage your accounts over time and do rebalancing. That's how you'll make money in the market, even though this week it feels like an awful time to make money in the market.
All right, Diane from Salt Lake City, Utah. Hi, Diane. What's your question?
Hi, I have a good question, and don't be mad at me. I have one of these. I have one of these 7-year arms that's going to readjust next year. I am retiring next year, and when I got into this arm, I'm not like the general people. When I got into this arm, I put down $30,000 because I wanted a 5.3 interest rate, which I got. It readjusts next year. I'll be retiring next year. I have in an account $100,000, and that's what I owe because I paid my loan down very diligently because of my low interest rate. Now, is it better for me to take my money out of the market, my $100,000 401k that I've got? Guess what? I haven't lost very much money in it. I'm really lucky. Should I take that out to pay off my house loan, or shall I try to find a readjustment? Now, my question was, I got in the mail an HLPR, which is a home loan repayment relief package from Mountain America that said that they would offer me 100% financing, no pay down, gift funds allowed, low introductory rate for 3 years, loan amounts up to $275,000.
Sounds too good to be true, doesn't it, Glenna?
It does to me.
Well, you know what? When it sounds like it's too good to be true, it probably is. Dani Babb, you want to take a stab at this?
Yeah, it sounds like 2005 all over again. First of all, the first thing I would do is your rate that you have right now is very close to what the 30-year fixed is, or if you can handle the payment, a 15-year fixed rate. It dropped again. It's down to 5.52% as of today. You can get some banks that will actually give you a negative margin, so they will deduct from that percentage rate. I would consider refinancing the loan. Tracy Burns made a great point on the show yesterday. I tend to be more return on investment oriented, and she made a great point that if it helps you sleep at night, it might be something that you'd want to consider. So if that's the case for you, if you're not going to earn the 5% in the market, and your tax liability on that 401k of cashing out your 401k is limited, you might want to consider it and just pay off the loan.
Diane, I gotta jump in because you're kind of conflicted here. On the one hand, and I go to Dave Ramsey usually when I'm in a fix. On the one hand, he says never take out your 401k, never take anything out of that. On the other hand, he says pay off your mortgage as soon as you possibly can. So you have to decide for yourself which is the lesser of the two evils or the better of the two virtues here. Thank you, Diane, for the call. Let's take an emailer, Josh from Indianapolis. He asks, would it be a wise strategy to increase my 401k contributions in these current market conditions? Dominic, what would you tell him?
This is a great question. I love this question. So if you're not retiring next week or next month or any time in the near future, this is exactly what you should be doing. Number one, you're taking pre-tax dollars. Before the federal government and state government gets their share, you're taking those dollars and you're dumping them into your retirement plan. You're probably going to get some kind of employer match on the dollars.
Which is free money.
Which is free money. And you're buying...
Really is, by the way, that phrase is overused, but when your employer is matching it, it really is free money. You don't have to
you
put a
will
dime in.
not get if you don't make the contribution.
So you can't afford not to make the contribution.
And you're buying shares of these mutual funds inside your retirement plan at a 20, 30, 40% discount.
And Leo, you don't have to put that into a risky stock-based account. You can put it into a money market account.
Well, again, it will definitely depend on your personal circumstances, your horizon until retirement and your risk tolerance and all of that. But in general, it's probably, again, a good idea to start investing at these distressed levels.
All right, let's go back to the phones. Pat from Racine, Wisconsin is on the phone. Pat, go ahead.
Okay, I'm 67 and I'm retired, and everybody keeps saying your 401k, stay in it. But I'm retired, so I left it with my company, which is Fidelity is handling it.
Right.
I'm down 10 grand already. Should I go with a financial advisor, pay him a commission, and hope to recoup over some time?
Okay, good question. By the way,
should
quickly,
I take it and pay government taxes on it?
Okay, hold on a second. Tell what percent of your income did you lose?
Over
over the past couple of weeks?
It was 57,000. It's down 10.
Okay. All right. Well, let's go to Rod first. Well, what do you think about that? Does she need an advisor?
Well, my question to her would be, does she need the money absolutely right now? It sounds like she was probably pretty comfortable. It's a big chunk of money. You hate to see that go away on paper. But again, if you don't need the money, it is on paper. I think it gets back to something you mentioned earlier. I mean, if this is something that's keeping her up at night and going to that advisor will help her feel better about her decision one way or the other, then it might be worth it. That these are very unsettling times.
Dani Babb, I'm told that these advisors can be as cheap as a couple of $100. Is that true?
Yeah, I've seen them as cheap as a couple of $100, but I think that you get what you pay for with pretty much everything. Personally, I mean, I would just stay where you're at. You haven't done worse than the market, and that's one thing. You're not really taking a loss. It feels like a loss emotionally. I look at my 401k and I don't like it either. It feels like a loss, but you're not taking the loss until you cash out. So I'd hang in there.
All right, so Pat, hang in there if you can. David from Delray, Florida is with us. David, go ahead.
Hey, great show, David.
Thanks, David.
Fox Business rocks. Hey,
we think so.
My question is, what kind of confidence can an investor have in this market when CEOs claim publicly one thing, but then actually behind their back do something else? For instance, on September 11th, Lehman Brothers claimed in an investor conference call that they didn't need additional capital. But in fact, they were looking for $3 billion from the Europeans the previous day. That's unbelievable, and it destroys morale and investor trust.
Dominic, trust and confidence is what this is all about. How do we regain it?
Well, it starts with our politicians, I'm sorry to say. We're hearing things coming out of their mouths and then finding out later on it's not, oh, no, the picture isn't exactly what you painted it out to be. So if we don't have confidence in Washington, D.C. and our regulators that they're going to do their job, how are we supposed to have confidence in that?
But, Rod, I don't think we can wait for Washington to get it because they're not going to get it. They haven't got it so far. They're not going to get it. We have to rely on ourselves. Confidence building begins right here, Rod. 20 seconds.
And if you've been watching Washington for the past few weeks, you know that they don't get it. I think this, in a weird way, underscores the point of diversity with your portfolio because, to a certain extent, you can never control what an individual company, individual stock will do. So if one is doing shady things behind the scenes, but you have it spread out across a bunch of companies, different investments.
Last word, Rod. Thanks very much. Coming up, here is an absolute. You folks out there know a lot more than any of the experts you've heard tonight or any other night. My final score next. Well, last week we wondered on Final Score how soon it would be before the next bailout, and here we go. Less than a week after the bailout of the banking industry's bad debt, we get news that the Fed is going to start lending directly to companies that want to issue debt. It's kind of amazing how such a monumental change in the Fed structure is being buried amid a lot of other news. But make no mistake, this is big, and this is bogus. Again, we are socializing debt. But this time, not just banking debt, we are now socializing the borrowing needs of private companies. Of course, talk of socialism will be met by scorn from the experts. You're going to be told that the Fed is not the government, that it's just a private bank, and this is what private banks do. But no other private bank in the States can print money like the Fed can. And when the Fed runs out of money to cover all its new commitments, it's going to be forced to print money faster than the economy is growing. That means we all pay in the form of inflation. We pay the price for the advice of experts who got us into this jam. And the politicians keep defying our skepticism by taking the advice of these people. Now, Scoreboard continues to believe that the collective wisdom of the American people is smarter than any group of experts, and that the longer we defy the wisdom of the people, the longer this crisis will last. Thanks for joining us, everybody. We're back here tomorrow to answer more of your calls and emails. The revolt begins right here. Dave Ramsey is up next.